In 2022, my federal and state tax bill was a net of zero thanks to my Airbnb properties. I want you guys to click the like button down below, subscribe to this channel, and I'm going to tell you exactly how I did that. But first, for this video especially, I want to tell you guys that I am not an accountant, I'm not a CPA or any other type of tax professional. And just like all the other videos that I put out, this is just my experience and the way that I do things, and I am not your financial advisor or your tax professional. So before you guys go forth with any of these things, because your tax situation is probably different than mine, I recommend that you reach out to your CPA and your accountant. I recommend that you have good ones of those anytime that you are involved in Airbnb or any other type of business, because they are a gigantic asset to help you keep more of the money that you earn. What's up, guys? Welcome back to Airbnb ABC. Super happy to have you guys here. If you are at this channel or any other real estate channel, you know that real estate is a fantastic way to build wealth and to build cash flow so that you can enjoy your life. You're not stocking away all your money in a 401k. That is only going to be available to you once you're 59 and a half or more. And when you're looking at different types of real estate, the short-term rental game, the Airbnbs, the VRBOs really supercharge the amount that you are going to be making all throughout your real estate investment journey. They make money in three different ways. The way, number one, and the one that you're probably most concerned with, is cash flow. And cash flow with short-term rentals is exponentially higher than with long-term rentals or pretty much any other type of real estate strategy. I did long-term rentals for, I don't know, about 10 years or something like that. And then I moved into short-term rentals because the gains were just so much better. You end up getting appreciation with any type of real estate that is in a relatively desirable area. Obviously, there's places like parts of Baltimore, Detroit and such, and Cleveland. There's places all over the country that you can say that did not go up in value or do not go up in value all the time. But for the vast majority of real estate out there, you're going to get appreciation. And this is likely going to be your biggest gain in wealth, in money, over the course of your real estate investing career. That cash flow is nice because you can spend it on a vacation or a car or reinvest it into stock market or something, but appreciation is going to be your biggest gain. And then note pay down for people renting your places, whether they are tenants or guests, they pay for the principal amount pay down of your buildings. And then all of this can all be purchased with leverage, where you only have to put down 5, 10, 20, 25%, and you get access to the entire building. You get all of the benefits of the appreciation and the no pay down for the entire building. And it's just a great way to build wealth. Everyone that's clicked on this probably knows that already. But the fourth major benefit of real estate is the insane tax advantages. If you guys are even remotely familiar with real estate, you've been looking into it, if you're already in the game, you know that real estate is probably one of the most tax advantaged investments that you could probably get into. It gets even better with the short-term rental game because you are making more money, but there are very specific ways that being a short-term rental host benefits you in a gigantic fashion, especially if you are a material participant. And we're going to get to that in just a little bit, because that particular part there, being a material participant and working within the confines of the short-term rental loophole, can just absolutely next level your tax preparation, your tax planning game, especially if you are a high W-2 or 1099 earner. So the first thing with this major tax advantage of working with real estate is that pretty much every expense that you have is tax deductible. And what that means is that for everything that you spend money on, you can deduct that from the amount that the government is going to tax you on. So if you make $100,000 and you spend, let's say, $2,000, now your taxable income is only $98,000. If you spend $50,000, your taxable income is only $50,000. That's probably a more reasonable example on that. But that means that it's just deducted from your gross revenue. And this is pretty much everything that you spend money on, from your insurance to your property taxes, interest on any mortgages that you may have, utilities, cleaning fees in the short-term rental space, repairs, pretty much anything that is used up within that 1 year time frame. There are certain things such as upgrades, like if you upgrade an HVAC system or a roof, that has to be depreciated over time because it does last longer than 1 year. But for the most part, most of your expenses that you're going to have in any 1 year are going to be deductible in that year. And so that takes away from the amount that you're taxed on at the end of the year. But this second thing that is really important and is really what makes investing in real estate such a massively tax advantaged investment option is depreciation, and depreciation on the building. What that does is it says, according to the IRS, that even though that building is going to go up in value, which is one of the three major ways that you make money in this game is through appreciation. But the IRS says that that building and the contents inside that building have a usable life. And depending on how it's classified, if it's classified under residential or if it's classified under commercial, which most short-term rentals, and I would venture to say all short-term rentals, fall under the commercial depreciation schedule. You basically take the value of that building. This is not the value of the entire property because the land does not depreciate. You take the value of the building, divide it by 39, and you can deduct that from your gross revenue as a deduction every single year, even though it didn't really even happen. It's essentially can become a paper loss, and it is a paper loss that really doesn't affect your cash flow, doesn't affect the money that you have on hand, and actually your building appreciates over time. So it's kind of counterintuitive, but it's one of the major benefits of owning real estate. This paper loss of depreciation then will cover most of the rest of your profit, most of the rest of the revenue coming in that the regular deductions, like your interest and your utilities, cleaning fees, and things like that, don't cover. So you might make money in real life and have a taxable loss at the end of the year. And I hope you guys can see how this can really affect your bottom line as far as how much money that you are being able to take home at the end of the year versus how much that Uncle Sam is coming after you for. It gets even better as all of this income is considered rental income by the IRS. And so you are able to report it on a Schedule E, which is for passive income. And so it does not get subject to the absolutely ridiculous self-employment taxes that people that are involved in self-employment business or self-employment activities are subject to. And those self-employment taxes are pretty substantial. And it's just one of the major benefits of investing in real estate just in general. It gets even better if you are self-managing your short-term rental. If you can prove that you materially participated in your rental activity, and what that involves is there's like a 7-step or 7-item test that you can look at that the IRS puts out that says that you are a material participant. The best one of these to go for is the one that just says that you have put in 500 hours or more into the business. A lot of folks look at the one that says that you've spent at least 100 hours and more hours than anyone else, but if you were ever to get questioned about that in tax court, it is very hard to prove how many hours everyone else, such as your cleaners or handyman, has spent working on your business or within your business, and so it's much easier to try to meet that 500-hour mark if you can legitimately do it. If not, I never recommend you trying to cheat your taxes or trying to do anything like that, because that can land you in big time hot water.
Right to jail, right away.
But if you did materially participate and your average stay is 7 days or less, and for most folks out there that are renting these on Airbnb and VRBO, your average stay is much less than 7 days, you can take advantage of the short-term rental loophole, and you can take some of those passive rental losses. Now, again, we're not talking about actually losing money. We're talking about paper losses due to depreciation, and we're going to get into here in a second with cost segregation and accelerated depreciation. You can use some of those losses against your active income. This is going to be your W-2 income, your 1099 income, and self-employment income, and this is where things get really interesting for the tax strategy around short-term rentals. So like I said at the beginning of the video, I ended up not paying any tax net on my federal estate. I did pay a bunch of taxes up front. I paid about $10,000 in federal and state taxes for 2022 from my W-2 employment. In that employment, I made about $100,000. And for some folks, that's going to be quite a bit of money. And for a lot of folks out there, that's going to not be that much at all. But that is just where I stand for 2022 from an active income standpoint. But also in 2022, we did a couple of things that really boosted the amount of taxable losses that we were able to take for our short-term rental business. The first 2 cabins that we had, they produced, I think, about $150,000 in gross income, somewhere around 50 to 60,000, maybe 70,000 of net profit. When I split that between my business partner, you're looking at, let's say, $35,000 of net profit before we had depreciation taken off for those buildings. At the end of the day, I think when I talked to my accountant, we had about $10,000 or $11,000 worth of net profit, taxable anyhow, and our actual money that we brought in was significantly higher than that. And it just gets into the tax game and how you play it. We also purchased, and I purchased this personally, a cabin in 2022. We had a lot of acquiring costs as far as having to pay points, repairs, improvements that we made to the building right away. And being that we put it online in the end of October, we didn't have that many months to make a profit, so we ended up just taking a taxable loss on that particular property anyway. But we also did a cost segregation study, and this is where you take the building that you would normally have, where you would depreciate it over that 39 years for commercial property, and you say that there are items within this building that depreciate at different rates. The IRS sets up schedules for this into 5, 15, I'm sure there's some other schedules, and then the 39-year schedule. And these are things such as flooring, appliances, cabinets, countertops, even the wiring. They're all depreciated on different schedules. And what we did is we hired a company to come out and do a cost segregation study, and that is where they come out and they break out all of these things into their individual depreciation schedules, and it will allow you to depreciate that in a faster way. That ends up giving you more tax deductions up front in the first part of owning this building, and you can even do bonus depreciation if it fits in with your tax strategy. For us, we had so much deductions from depreciation and losses that we were able to use that it wouldn't even benefit us, according to our tax advisor, to take that bonus depreciation. But if you are somebody who makes $200,000, $300,000, $400,000, $500,000, $600,000, $1 million a year, you may be able to shelter a gigantic amount of your active W-2 or 1099 income by using this short-term rental loophole, short-term rental cost segregation, tax sheltering strategy with materially participating in your business and being able to do that. With those paper losses that I was able to take, I ended up getting back just under $11,000 in returns from my state and my federal income tax returns. And so when you look at that, I only paid in 10, I got almost $11,000 back. And if you're wondering how you can get back more than what you've actually paid in, it's because of the child tax credits and other credits that are refundable. And so at the end of the day, at the end of the year for 2022, I paid a net of 0 or maybe even less than 0 in taxes to the federal and state governments. Now, obviously there was there was still county taxes, there was property taxes, sales tax, so I still paid quite a bit of tax in general. But when folks are looking at their, end of the year, are they going to owe money? Are they going to get a refund back? In this case, I had a net of 0 thanks to owning Airbnb properties, managing them myself, and getting an accountant that could help me work through all of this because, again, like I said, I am not a tax person. I know enough to basically get myself in trouble, and so that's why I outsource all of my tax stuff to an accountant that is qualified and it knows how to navigate these very technical waters. So guys, if you like this video, click on these ones that are above here right now. They're going to tell you guys all about the types of property we buy, how we manage them from afar, all the trials and tribulations of running a short-term rental business. Like this video for me. It really helps me out in the YouTube algorithm. Hit the subscribe button down below so you don't miss anything else that I put out on this channel. I appreciate you guys watching today. I'll see you in the next one.